we stand between you and getting home or having a drink or whatever it is that, and it's been a long day. So do our best to make this as interesting as possible. One of the things I was particularly delighted about, my two guests here on either side of me, is that we have a perspective, and I think it's probably a nice way to end the day. We've heard from Monica a number of times during the course of the day around the EU and what's happening in the EU, which I hope you found as interesting as I have. And now we have Diederik here, who's also going to talk to us from an EU perspective. And on my left, we've got Sean, who's going to talk to us from a South African stroke Pan-African perspective. So normally I'd like to have, when I have questions, I'd like to put the different questions to different people. But because I think we have this unique opportunity to have these two people talk to us from their particular perspective, I am going to put the same questions to them, and I have particularly asked them to use their context to answer it. So before we go any further, let me introduce our guests. Sean is a young emerging payments and payment partnerships professional. Can I also say that I'm young? It doesn't work so well anymore. Who has already had an exciting career, working on payment problems in industries ranging from mobile gaming and now banking at Absa. He thrives on customers' perspective, always putting himself in the shoes of the ordinary African customer to solve our financial inclusion through creative and sustainable hacks. And I really like that, ordinary African customers, because I think has been mentioned so often today, we have a very particular nature of people on our continent, and that solutions that necessarily work all across the world won't necessarily work here. Now, Diederik, on the other hand, is a very interesting person from the perspective that he works for the oldest global banking association, the World Savings and Retail Banking Institute, that will celebrate its 100th anniversary in October this year. He's one of the rare banking representatives that's not only into cashless payments, but also closely follows cash. And that is a very interesting perspective. And again, it has been raised a number of times in the course of today, the fact that as much as we want to talk about cashless or cash light, as I prefer to say, we cannot forget the elephant in the room is cash, and it ain't going nowhere. Well, we're trying. Now, I added this because I asked each of the gentlemen to give me their little story, and I think that Diederik has a little bit of extra to add. If you don't mind, Sean, he's not as young as you. I hope that's okay.
2 years, maybe.
So there's a little bit more there to add to his story. In addition to what I've just told you, he worked for the European Central Bank for a number of years and was a member of the Digital Euro Advisory Group. So I think that that is a particularly important point in the course of today, because the discussions we've had earlier on of the role of digital euro, and I'm not sure what the agenda is tomorrow, I'm not here, but we didn't in our panel get to talk about CBDCs, and I think there's a lot of room to talk about that. He was also previously on the European Payments Council, and my personal favorite is his role on the editorial board of a publication that I greatly admire. I really consider it an almost academic level, very accessible publication. So here's a punt, Journal of Payment Strategy and Systems, published by Henry Stewart Publishers. And if you really can't sleep, no, it is a very good publication. Okay, so let's launch into the questions. So as by way of introduction, I've asked both Sean and Diederik to comment on the evolving payments landscape from their perspective. And Sean, have you been here all day? No. Okay. So there's been a lot of discussion. I mean, we've covered an enormous amount of aspects of payments. So consider the audience to be a little bit in the subject, in the context. But perhaps you could just tell us, in your view, and how you see this evolving landscape happen. And when I say payments, I mean, we can go, whoa, from high value, low value, retail, mobile money. So just give us a little bit of your feeling about payments on the African continent. You can even take a little bit lower, sub-Saharan, or even lower, just talk about SADC or South Africa.
Thank you so much, Kim. So I'm going to bring it all the way down and, of course, talk from the customer's perspective on this particular question. Right. So from my perspective, I really do think that the changing and the evolving payments landscape that we are seeing in the continent in general, I would say, is because of the transforming customer expectation, right? I think the mobile and also the internet sort of technology revolution that we are currently in is definitely reshaping the way that people interact, the way that we work, the way that we learn, and the same digital adoption is also fundamentally changing the way that customers transact and also bank, as well as the expectations from it, right? So we're seeing customers now demand converged services, seamless digital experiences, one which are convenient, flexible, and sort of embedded and integrated into their digital lifestyles, right? And I think the market has responded really positively to this. This is why we see a lot of innovative fintechs, such as your Zappers and your SnapScans, enabling very exciting use cases for you to be able to pay, through your mobile devices and your wearable devices, such as smartwatches and so on. Even on the acceptance side, we've got a lot of work, being done by people like Yocos and Ecocos, who are improving digital acceptance, in the informal and also in the sort of cash-heavy sectors of the economy. So that's one thing. Another thing I think that is happening, in the sort of evolving payments landscape is that there are a lot of, and I know that, the topic is probably touched on quite a few times today, is the emergence of all of your new fintech players and also alternative payment systems in the market, right? And I think from a South African perspective, this is mainly driven by the regulatory shift that's happening. I know that the previous panel did touch on some things that are happening on that level. We've got things like the Coffee Bill coming in. We've got things such as Regulation 13, the MPS Act, all of which are making it much more easier and feasible for your non-banks to do things like deposit taking, issuance, and so on. And then if I look at it from a broader sort of continental perspective, versus South Africa, I would say that that change is being informed by the market, right? Because obviously they're a cash-heavy economy. They don't have a mature banking system like us. So there's obviously a huge commercial incentive for them over there to decash using all of these innovative digital solutions. And so that's why we see a lot of success from people like your Pagas, your OPays, and your Chipacash.
Okay, so you mentioned a lot of names there. All of them are amazing African fintechs, and we'll have to give a punt too for our African banks. But Diederik, from your perspective, given what Sean has just said, I think there are a lot of similarities to what the European experience is, but perhaps you can pick out pieces that are particularly important in Europe and that Europe has had some experience on already that we could hear about.
Yeah, thanks for the question, and thanks for having me over. Of course, if we speak about Europe, it's in fact a set of different countries. And we speak about a single market, but if you look into the single market, we have basically two areas. There are those countries that have the euro as their home currency. They used to have different currency in the past, but they switched to the euro, not all at the same time, but at different paces. Lately, for example, Croatia joined the euro about 2 years ago. And we have those countries that still carry their home currency as is. Means that European regulation applies to all those countries, whether you have the euro or not. So most of it, some exceptions are being made for your transactions. And if you zoom out a little bit, there are 143 billion cashless transactions made in the EU. Which is growing at the 8.6 year-over-year growth rate over the past 5 years. And if we look into that a bit more detail, we see 52% of those transactions are made with payment cards, and that's even grow at a higher growth rates of 11.5%. So that's quite some impressive figures.
Cards are increasing.
Cards are increasing and even faster than the total number of cashless transactions. So that's quite good news, I would say, for those that love the cashless transactions. Of course, there's also still cash around, and according to research of the ECB, still 59% of all transactions at the point of sale are made with cash, which is down to 71% of the same research about 4 years ago. And that gives then a bit of contradictional figures. We see the cashless transactions increasing. We see the number of cash transactions at the point of interaction decreasing. Nevertheless, we see cash in circulation increasing as well. Of course, that is due to the fact that cash has more function than just the transactional aspect. But what is interesting is that out of this big chunk of cashless transactions that are made with cards, 2/3 of them are made with cards under the brand of card schemes that are not governed in Europe. In Europe, we still have domestic card schemes which function locally, and the only reason why you can use those cards in another country is because they're co-branded with another card brand, notably brands owned by Visa and MasterCard. And you have countries that used to have a domestic card scheme, but they got rid of it in order to be able to comply with the pan-European regulations. And the fact that those 2/3 of those card transactions are basically governed on the card brands that are not governed in the EU raises some concerns by the EU regulators, and that's also driving some of the regulations that Monica mentioned. For example, of course, the digital euro is about monetary stability, monetary anchor, having a cash equivalent in the digital world, but it's also to make sure that there is a payment system out there that's governed in Europe. The same goes for instant payments. Instant payments also should become the new normal, not only because the EU regulators want to have just more speedier transactions, but they also envision instant payments to replace at least some transactions at the point of interactions, cannibalizing those of cards. So we see a lot of cashless transactions, also still cash. It's quite, I would almost say, critical part of the economy. As such, we see a lot of regulations eyeing in it. There is the Payment Services Directive and Payment Services Regulation about customer security, licensing, more competition, transparency in pricing, and I would argue that it's almost also on price regulation.
Sorry, could I just interrupt you? One of the pieces that interests me particularly is this rise of instant payments. Okay, so regulators across the world, from my perspective, are pushing the instant payments dialogue, and almost every country that I interact with or look at has an instant payments rail. So you were just saying that card is increasing. Now we're talking about instant payments. What do you think ultimately will instant payments see card usage coming down, or do you see instant payments just becoming an alternative and complementary rail?
I would say that instant payments will not really cannibalize cards. There might be some local solutions, or maybe even pan-European solution be developed that can leverage instant payment rails, maybe notably in the P2P segment, because there we really lack a pan-European solution. You have a lot of P2P solutions, but they only work in the country. If I want to pay for my Dutch bank account to Monica at her Italian bank account, I'm out of luck. By Dutch P2P app will not reach Jiffy in Italy.
And for Europe, that is saying something.
Yeah, that's something where the regulators say, look, there is a market failure. One could argue, though, how many cross-border P2P payments on average this one made. But the most important argument is if we want to have instant payments replacing card transactions at the point of interactions, who's going to promote it? Who's going to fund it? And one of the problems we have with instant payments is that it has not a nice underlying business model as we have with cards. There was a gentleman here early this morning who argued now we should get rid of interchange and let each party in the payment bear its own costs, and we take it from there. I would tend to disagree with that. I think one of the reasons why these card transactions in Europe are so successful, despite relatively low interchange fee levels compared to other geographies, is that everybody loves it. Consumers love it, merchants love it, and the banks issuing and acquiring it love it too. Okay. And that's because on the one hand of the good underlying business model, but also all the convenience and customer protection, you can tap and pay, whatever comes along with it.
And I think that you make a very big point there, and actually that was something earlier on. I don't believe that the card schemes have done a good enough job of having us realize the actual protections that you have as a consumer in a card payment. So, Sean, to you, we have PayShap in South Africa. Absa is one of the participants in PayShap. That's our instant payments rail. So my question to you is, having heard what Diederik just said, what is your view on this card instant or faster payments trade-off?
Thank you so much for the question, Kim. So of course, Absa is a participant, in the sort of industry level bank serve PayShap question, but what we are seeing and what is even more interesting in our area is that a lot of fintechs are also wanting to now enable all of your RTC sort of payment use cases. And for us, it's quite interesting, right? Because this activity is not coming from people who are traditionally interested in sort of card payments, but even coming from retailers, MNOs, etc., who may have your sort of loyalty programs, but are now coming into sort of wrap around your card programs in that proposition. The take up of our RTC product, Kim, I could say that it's doing well, steadily, but I can still say that there are some exciting and interesting times ahead.
So you mentioned fintechs, and I mean, I'm going to call them non-bank participants for the purpose of our discussion here. So the fact that they are part of the payments ecosystem is, I'm speaking because I'm one of them, but it's pretty much a reality. I mean, it's not a question of if or should or whatever. So we heard earlier on, I think it was, an Absa person talking about a partnership with Ozo. So from a bank perspective, and again, taking it to the PayShap, these fintechs that are wanting to come, or non-banks that are wanting to come into the PayShap environment, is that a collaborative with a bank, or is it as they want to actually on their own book participate in PayShap? What is your view about, and then I'm going to ask you the same question, whether this is a space that we allow non-banks into to partner with banks, or is this a space that non-banks can come into and participate in their own right?
Thank you so much, Kim. It's a huge question, and there's a lot of action happening on our side, on both the issuing as well as the acceptance side. Like I just said, a lot of your card programs, a lot of your retailers are coming in to want, BIN sponsorship as well as joint ventures. That's on the issuing side. A lot of our payment facilitators and our payment aggregators, as well as our ISOs, are coming in, to be interested in becoming designated clearing system participants. That's on the acquiring side. But I think the most interesting thing that's happening is that all of these players are now wanting much more independence and also much more sort of central or even core responsibilities in our national payment system. And I can say that we are still scratching our heads, in terms of the best commercial model in order to be able to monetize all of these products and solutions in the market. And I think there's also a great lesson to be learned, if you consider the fact that very few or little tier one banks locally or even internationally are currently sponsoring any store value sort of propositions, right? And it's a no-brainer. Why, right? Because I think it's very difficult to sort of justify the commercial business case versus the enormous sort of risk that you are exposing yourself to when you are extending your sort of banking license.
Yeah, so we're talking alliance banking, GN5 and that kind of thing.
Absolutely,
Yeah.
absolutely. So, while there isn't a standard way of engaging and also operating these business models, we still are looking for the best commercially sound and sort of a strategically sustainable way to work with these partners.
So Diederik, in South Africa, we have a little bit of an unusual situation, and perhaps it's not, and perhaps you have it that you can, as a non-bank, form a partnership. We call it alliance banking with a bank. I won't go into the regulatory framework because you'll all be definitely asleep. But that is one way that non-banks or fintechs are able to participate in the financial services space. So my question to you is, do you have that scenario in the EU environment? And in terms of participating in the payments ecosystem, we spoke earlier on, Monica told us about the EMIs and payments, what was the other one?
PIs.
PIs, payments institutions. So, just give us an idea of how that looks in the EU based on what Sean has told us Absa is facing in South Africa.
Let me just give a bit of history. About 10 to 15 years ago, we had those type of fintech companies that were just engaging in the payments business. On the one hand, they did payment initiation, and on the other hand, they did account information. But they used a technology called screen scraping for that. They would just take the customer credentials, go to the banking website, and either initiate a payment or pull all the data that they needed out of there to deliver services to the customer, which, of course, and I think with most of us bankers here in the room, all would agree, this is not the best way to give access to customer accounts, which is happily enough also recognized by the EU regulators. So comes in PSD2, as Monica mentioned in their historical overview, meaning that on the one hand, these actors now need to be licensed entities. So they became from a fintech, they had to become a PSP or a PI. And they have to fulfill certain criteria. And on the other hand, banks were now forced to give access to certain pieces of data, and not in the form of screen shaping, but by delivering dedicated APIs for that. So one would say, okay, everybody would be happy, but comes the implementation, one found out on the one hand the fintechs were not unhappy because initially they would realize that PSD2 would meaning that their business model would be rubber stamped, which was not the case because their access to a certain account data was limited compared what they do before. And for banks it was also a bit of a catch-22 because they had to invest in APIs, they had to invest in additional security, whilst on the other hand they had to give access to these fintechs for free. So at the end of the implementation, everybody was equally unhappy, and quite significant battles took place between fintechs and banks, and it was part of that arguing, okay, when is an API compliant with the rule and what not? Of course, as a banker, you would go for the bare minimum. If the law says you have to give access to that piece of data and that piece of data, you only deliver that, and did give more insights in all the other nice pieces of data that the fintechs wanted. So that also made realize both parties were equally unhappy, which brought the parties together. And at the moment, discussions are ongoing between banks and fintechs to come up with some kind of maybe multilateral agreement where fintechs would pay a little bit to have access to additional pieces of data in order to be able to deliver better services. So we see a little of, I would say, kind of waves where sometimes you are foes, sometimes you are friends, then it evolves a bit. But the key message here is, of course, what at least is the party line from the association I represent and the banks I represent is we welcome, of course, fintechs and competition, also in payments. But if these type of actors perform same type of activities we perform, they run and face the same risks as we perform, they should face the same rules. So there should be also a level playing field from a regulatory or maybe even supervisory perspective for those actors that engage in that type of business.
100%. And that's why we're looking at this activity-based regulation. Okay, so we've spoken a lot about what I would like to put into the concept of let's call it retail payments. And somebody recently said to me, the reality is that 90% of the value of the payments going through the South African payment system are what we call high-value payments. So it's a space that is the sacred inner circle of payments, and it's the banks, because that's when the money actually changes hands. So the commercial banks are highly regulated, are highly governed by the Reserve Bank, and that particular space is the preserve of the banks. So when we're talking about actual value of payments, the value lies in those high-value payments. So my question to both of you is, just having made that statement, where does the power lie with the banks going forward? We've spoken about fintechs, non-banks, payment institutions, e-money institutions, call them what they like. We've spoken about, Julian spoke earlier on, why would we enable a competitor? Fair enough. Used to work at FNB. Heard that daily. Why would we enable a competitor? So there's a lot. The cake is big. And when we talk about financial services and banking services. So why don't banks just say, you know what, we got most of the value that's going on. Let the rats and mice be to the non-banks and the fintechs kind of thing. So where does the power lie in the banks, for the banks going forward in this evolving ecosystem?
Right. Very, very, very challenging question, Kim. Thanks for that.
That's the closing question.
So I would say that the power of the bank, especially in South Africa, would definitely lie in trust, reliability, security, and stability, right? Of course, fintechs and all of the new entrants do come in to solve a lot of the problems, that the banks don't have the speed to market, the flexibility and the innovation to be able to address at the moment. Like, for example, their difficulty in sort of acquiring new customers and growing their bases, especially in those hard to reach sort of lower LSM value segments, you know, ones that are mostly in South Africa and the rest of Africa, I can imagine, in, you know, sort of remote, rural, and even township economies with very little sort of tech infrastructure as well as physical sort of branches and channels. And that's exactly where, you know, these fintechs and these new entrants specialize in, right? But of course, there are some things that they can't still do, you know, without the support, the collaboration, and even the sponsorships of the banks, right? And that is mostly compliance and regulation, licensing, and even capitalization, right? This is definitely where the banks are still very strong at. Like you said, well regulated, well controlled, well financed, and you know, the banks still remain the sort of captains in terms of the knowledge and the expertise when it comes to all of your regulatory and legal compliance things. The fintechs, on the other hand, very fragmented at the moment. I mean, the panel before us, you know, did mention that we finally do have a fintech association of South Africa. You know, things like cryptocurrencies have only recently been sort of categorized as financial products. So there's still a lot of work for them to do. And the banking system, I would say, the power and the relevance of the banking system is definitely, you know, in its maturity as well as in its legacy.
So they ain't going anywhere.
They aren't going anywhere.
Thanks also for this interesting question. As you mentioned, indeed, 100 ago, the World Savings Bank Association was established to basically cement a business model that even exists longer. And I think also the next 100 years, savings banks and banks in general will be the safe haven for consumers to keep their funds, to be the trustworthy advisor during rainy days and during sunny days, whatever it takes, as also evidenced in the last crisis that we went through, where our members still supported all the clients regardless. So having said that, I think banks are unique. They will also remain unique. And of course, we welcome competition, but again, it should be fair. Same rules should apply. And Monica mentioned that the fintechs in Europe are now also allowed to have access to the settlement systems, which is of course interesting. It's good along again as long as the same rules apply, which means I wish them lots of success and lots of compliance personnel that has to come along with that, which maybe not will fit into the business model because they are just at the moment just trying to come in with mono-line offerings, underpinning our pricing. But apparently the business model is, in most cases that we analyze, is built on just burning shareholder money, which is not a long-term sustainable business model. And if we would do that as banks, we would immediately spanked on the head by the regulator or the supervisor, so we have to stand corrected, if we burn our capital just to underpin pricing. And also we saw in the PSD2 a lot of actors being licensed as payment institutions for other account information services or payment initiation services. In Europe and maybe globally, payments is a difficult business. Consumers don't like to pay for the privilege of being able to pay. So it's very hard to make money there. You have to either have a very unique offering or you have to make huge volumes in order to be able to have a sustainable business case, which is for fintechs sometimes difficult to get. So we see some merger and acceleration taking place. Fintechs that are very successful are either being taken on by banks or by the big card schemes, for example. But we also saw a peak in licenses granted for these new type of payment institutions across Europe. But we see now again the number of licensed institutions decreasing. Of course, on the one hand, it's maybe driven by some M&A activity, but I think also a lot of fintechs just decided there's no money to be made and they just terminated the thing, which come to question. It was also, not sure whether it was the last panel before about open banking. And who needs open banking these days? Nobody woke up in the morning, or data sharing in general. Nobody here in the room probably woke up this morning. Today is a very nice day to share my data with someone. So there's no, let's say, primary need for that. And there might be a hidden need. You might have been woken up this morning, okay, am I paying the right fee for my mortgage? Or is my pension plan right? Which then you might need some data from across the financials you use to make that assessment. And fintech can very well play a role there. But am I wanting to pay for that as a consumer? Probably not. So the fintech maybe can earn some money by a kickback fee if it manages to sell a mortgage or an insurance or an initial pension plan. But this happens maybe per consumer. Once a year is maybe already optimistic. Once every 5 years that you make that assessment, I wish them good luck.
Thank you, Diederik. Bill, thank you everybody for hanging in there for the graveyard shift. Thank you to both of the guests. Really appreciate it. And I think it was really interesting to hear it from the perspectives of these two different jurisdictions, to say big jurisdictions. Thank you, everybody. I'm going to hand over to Brad to do the closing.
Thank you very much.
Thank you, everyone.
Thanks. I'm going to keep your microphone there. I'm going to grab this one because I'm going to...